end of December, end of 2019. It's a good time to talk about next year. Give me your thoughts on the outlook for 2020. What kind of growth do you expect? What kind of inflation? And what happens to the all-important Fed funds rate?
Right. And, the economy's performed really well this year. I expect to see growth around 2.25%. We have unemployment at 3.5%, near 50-year lows. And inflation's been a little softer than we would like to see. But I think looking at next year, I expect to see more of the same, growth around 2% for the year. Unemployment staying hopefully around where it is now at about 3.5% unemployment rate, steady job gains, and hoping to see inflation move back close to our 2% longer run objective this year. So I feel very good about where the economy's been this year, how it's progressed, and feel good about how it's going to look next year, very close to our maximum employment and price stability goals that we focus on at the FOMC.
When you say the unemployment rate should stick to, you hope it sticks to the 3.5, do you mean you hope it doesn't go lower?
Well, no, I actually would say 3.5 is a very good place. If it, we haven't seen inflationary pressures really emerge, even with very low unemployment. If the unemployment rate moved down somewhat, I actually think that would be very good in terms of a strong labor market, probably help move inflation back up. I don't want to see unemployment move up, a significant amount. But right now we got a strong labor market, really solid job gains, and our job I think of the FOMC is to keep that economy strong and keep moving ahead in the way it is.
People are using various terms to describe where the Fed is right now. I've heard the idea of a firm hold with a high bar to cut and a high bar to hike. Could you explain how you think about where the Fed is right now and what it would take for the Fed to move again?
Steve, I'm going to use a word you might be surprised to hear me use, and that's data dependency.
That was sarcastic for anybody who hasn't. John, I should point out, John Williams, several years ago, as San Francisco Fed president, had a T-shirt that said monetary policy is data dependent and gave it out to people.
Right. So, and it's still true. I think it's been true in 2019 as we saw the economic landscape shift and some of the risks around the economy shift. We obviously adjusted monetary policy this year, I think, very effectively to manage some of those risks and keep the economy strong. So when I look to the year ahead, I think monetary policy is in a good place. I think we're well positioned to support growth, support inflation back to our 2% goal. But as we've proven in the past, if economic conditions change in a material way, or the outlook changes in a material way, obviously we're ready to adjust our policy views accordingly.
Right. I mean, I get that, and you know that I get that. So the question becomes more of how is it data dependent? Is it one where you have to see a significant shoot to the upside on inflation in order to raise rates, and maybe less of a shoot to the downside to lower them?
I don't see it that way. I think it's pretty balanced in terms of where monetary policy is. I think with the rate cuts that we did this year, I think we've created a situation where monetary policy is accommodative. It is supporting growth, and I think that that's a good position for given what's going on in the economy. In terms of what would cause us to change the current stance of policy, I think it would again be a material change in the economic outlook. I can't point to one or two things in particular. I would point to this idea that maximum employment price stability is really important. We want to see the labor market remain strong. I want to see the inflation rate moving back to our 2% goal on a sustained basis. So those are the things I'm really focused on.
You had said back in November that you thought the risks were tilted to the downside. Is that still the case? You've had some improvement in some of the risks that you had. For example, trade deals. It looks like there's going to be a trade deal between the U.S. and China. USMCA looks like it's on road. Brexit looks like it's more has a handle on it. There's more of a handle on it there. Are the risks diminished now?
Well, I think there's still some significant risks to the downside. I hear from business people around the district about concerns about uncertainty about trade, uncertainty about global events. So even though we've seen, for example, in Brexit, we've seen the election and some perhaps reduction in uncertainty about what happens there, there's still the implementation of Brexit, uncertainty about exactly how that will play out. Obviously, there's geopolitical risks around the globe. And even though we've seen some positive developments in terms of trade, which I think does reduce uncertainty, and those are positives in terms of what I hear from businesses, there's still quite a bit of uncertainty around, global geopolitical and trade issues. So my view is that some of this uncertainty is going to likely be with us for the time being. Again, my outlook is very positive. I expect growth to be around 2% and unemployment to stay low. So
I'll ask two policy questions. First, is it a policy of the Federal Reserve right now to allow inflation to overshoot for some period of time?
So what I view the policy of the FOMC really is to make sure that we have we achieve our 2% symmetric goal, and that means that inflation, we want to be around 2%. Of course, that means sometimes a little bit, somewhat above, sometimes below, but really on a consistent basis, be at our 2% objective. Depending on economic circumstances, inflation might be a little soft relative to that, and other circumstances may be a little bit higher. But really see this notion that we're, on average around 2% inflation, sometimes a little bit above, sometimes below, and that's what I think the word symmetric means.
The recent rate cuts you had were described by the chairman as insurance cuts. Back in 1998, when you took out insurance cuts, you took those cuts back. Are these the kind of cuts you need to take back if those risks that you were insuring against go away?
Well, I think that, there are both kind of the risks and uncertainties that we've talked about, but there's also global economic developments. In the current circumstance, global growth has slowed. Some of those risks have actually turned into reality. We've seen downgrades to global growth from the IMF and others, and I think those are things that have shifted the landscape that we're operating under. So I don't see those reversing anytime soon. And as I said, although we've seen some positive developments in terms of the uncertainties, I still think there's quite a few uncertainties out there. So I don't have any prediction about reversing or any other policy actions. Again, I think that where we've got monetary policy is in the right place, supportive of growth, supportive of achieving our goals.
Another big area of concern of yours is the overnight lending market, the repo market. Do you feel confident now that after several moves by the New York Federal Reserve to inject liquidity and make liquidity available to the banking system and to the overnight lending market, is there enough liquidity to avoid some kind of crisis or rise of risk over the turn of the year?
So obviously for the last several months, the FOMC and the Federal Reserve Bank of New York have made, I think, really important decisions to make sure there are ample reserves in the system. We've taken actions in terms of building up our reserve levels through the purchases of T-bills, and we're doing overnight and term repo operations that add reserves to the banking system. Those have been highly effective. We're seeing interest rates like the federal funds rate, our target rate, staying right in the range that the FOMC set. We're seeing money markets operate very smoothly. Now, at the end of the year, typically at the end of the year, there are pressures that move certain repo rates and interest rates around for various reasons. I'm guessing that will happen this year as well. But from our position, we are, I think, in a very good position in terms of providing liquidity, providing reserves to the system, and importantly, keeping the federal funds rate in the range through the year, and also making sure that markets are operating smoothly.
John, we're almost out of time, but I do have to ask you this question. There's still a lot of discussion about what happened in September when there was a blowout in the repo rate and caused concern throughout the markets. One idea that's come up, the vice chairman for bank supervision of the Fed has talked about this idea that it was regulations and supervision that may have caused banks to hold back. Where do you stand on that? Do you need to relax the rules that require banks to sort of reserve a certain amount and makes not as much liquidity available to the repo system?
Well, here at the New York Fed, one of the key responsibilities we have is carrying out monetary policy for the FOMC. We have the desk, our group here, doing that. And so what in the direct response to what we saw in mid-September in terms of the turmoil in repo markets was to very quickly analyze what's happening, provide the liquidity, provide the reserves in the system, and obviously develop a longer-term plan to create the ample reserves that we need there. So what we've seen since then for the last few months is that interest rates are behaving themselves exactly as we'd like to see in terms of the federal funds rate. We're seeing market functioning return to what we saw before mid-September. So my view is markets are functioning well with the ample reserves. There were a lot of events that happened in the middle of September, but right now the markets are, I think, operating very well. Now, there are longer-term issues that will be, clearly will be under study, not only the Federal Reserve but elsewhere, to make sure that we understand all aspects of these markets and think through some of those issues. Right now, I'm focused on making sure that we're carrying out the monetary policy direction that the FOMC is setting, and that's working very well.